Imagine a city of 40,000 people, one of the largest concentrations of humanity on Earth. The year is roughly 3020 BCE. The city is Uruk in southern Mesopotamia, and somewhere inside a temple complex the size of several football fields, a scribe is pressing a reed stylus into wet clay. He is not writing a poem. He is not recording a prayer. He is writing down a debt. Last episode, we demolished the barter myth, the idea that people once wandered around swapping chickens for sandals until someone invented coins. That never happened. What actually existed were gift economies, social obligations, and community credit, systems held together by trust and social memory. But here's the problem. Social memory has limits. In a village of 150 people, everyone knows who owes what to whom. In a city of tens of thousands, that breaks down fast. And that's exactly what happened in Mesopotamia. As settlements along the Tigris and Euphrates swelled into the world's first true cities, something had to replace the mental ledger. The solution was breathtakingly practical. They wrote it down, on clay. And in doing so, they didn't just invent accounting. They may have invented writing itself. This is one of the most underappreciated facts in human history. The earliest cuneiform tablets we've found, from Uruk, dating to around 3020 BCE, are not epic literature. They're not king lists or religious hymns. They are inventories, debt records, receipts, tallies of grain owed to the temple. Writing, arguably the most transformative technology our species has ever produced, was invented to keep track of who owed what to whom. Let that sink in. Before there was poetry, before there was recorded history, before there was philosophy, there was bookkeeping. The first authors in human history were accountants. Now, the center of this system was the temple. In Sumerian cities like Uruk, Ur, and Lagash, the temple wasn't just a place of worship. It was the economic engine of the entire city. Temples owned vast tracts of agricultural land. They stored enormous quantities of grain. They employed thousands of workers, and they made loans. Think of them as a combination of the Federal Reserve, a commercial bank, and a massive agricultural corporation. They stored grain, set interest rates, managed the money supply, and extended credit. They were, in every functional sense, proto-central banks. And here's the key point for our story. This means debt and credit came before coins. The oldest known financial records predate the first coins by roughly 2,500 years. Coinage wouldn't appear until around 600 BCE in Lydia. But structured lending with standardized interest rates, that was already ancient by then. Speaking of interest rates, the Sumerians had those figured out with remarkable precision. The standard rate for grain loans was 20% per year. For silver, it was 33.33%. And these rates didn't fluctuate wildly based on market whims. They remained remarkably stable for close to 1,000 years. Why the difference between grain and silver? Probably because grain was perishable, essential, and seasonal. The higher silver rate reflected the scarcity and durability of metal. And there's a beautiful linguistic detail here. The Sumerian word for interest was mas. It literally meant calf. Because the logic of interest was rooted in the natural world. You lend someone a herd of goats, and that herd produces offspring. The loan grows. The same was expected of grain. You lend seed grain at planting, and by harvest it has multiplied. Interest wasn't some abstract financial invention. It was a metaphor drawn from biology. Now you might be wondering, what did they use for money? The answer is the shekel. But the shekel was not a coin. It was a unit of weight, approximately 8.3 grams of silver. Prices across Mesopotamia were denominated in shekels, which provided a standardized way to compare the value of very different goods. But in actual daily transactions, people often paid in barley. Silver was for large deals and long-distance trade. For buying bread or paying a laborer, grain was the functional currency. This dual system, silver as a unit of account, Barley as a medium of exchange is crucial because it shows how sophisticated economic thinking already was. These people understood that money doesn't have to be a single thing. It serves different functions, and different materials can serve different functions simultaneously. That's an insight some modern economics textbooks still struggle to convey cleanly. As trade expanded, so did financial sophistication. Babylonian merchants, particularly the famous trading families of the Old Babylonian period, developed instruments that would look familiar to any modern business person. They had formal partnership contracts called taputum, where two merchants pooled capital and split profits. They had commission arrangements. They had letters of credit that allowed a trader to access funds in a distant city. They even had a form of insurance against shipwreck for goods transported by river. This was not a primitive economy fumbling toward complexity. This was a mature commercial civilization. But all this credit created a recurring crisis. When harvests failed or wars disrupted trade, debts piled up. Small farmers who had borrowed seed grain couldn't repay. They lost their land. Then, they lost their freedom. Debt bondage was real. Families sold children into servitude to cover obligations. Left unchecked, the entire social fabric began to tear apart as wealth concentrated among creditors, and everyone else sank into permanent indebtedness. The Mesopotamian solution was radical and, to modern ears, almost shocking. Rulers periodically declared what scholars call a clean slate, a debt jubilee. All outstanding consumer debts were cancelled. Debt slaves were freed. Foreclosed land was returned to its original families. This wasn't charity. It was political survival. Rulers understood that a society where most citizens were crushed by unpayable debts was a society on the verge of revolution, or one that couldn't field an army. The economist Michael Hudson has documented how these jubilees were a recurring feature of Mesopotamian governance for centuries. They weren't anomalies. They were policy. And here's what makes this relevant today. After the 2008 financial crisis, when millions of people were drowning in mortgage debt, some economists, Hudson prominently among them, argued that we should do exactly what the Babylonians did. Cancel the debts, reset the system. The idea was dismissed as radical, but it was standard practice 4,000 years ago. It makes you wonder, did we forget something the ancients understood? So, here's where we stand. Mesopotamia gave us debt, credit, interest, contracts, financial regulation, and, almost as a side effect, writing. All of it born not from markets or coins, but from the practical need to manage obligations in a complex urban society. Debt came first. Money came later. And the struggle between creditors and debtors. That started here too. But as trade grew and debts mounted, a new question emerged. What happens when the ruler doesn't just cancel debts occasionally, but tries to write a permanent set of rules governing all economic life? That's exactly what one Babylonian king attempted. His name was Hammurabi. And his code changed everything. That's next time on History of Economic Thought.